How do lenders calculate your income when you're qualifying for a mortgage? Is it different for a salary pay structure versus hourly or commission? Do you need 2 years work history? These are all questions that my dad answers in this video.
Whenever you are in a salary position, it's a fixed income. You know what it's going to be every month. And so an underwriter doesn't need a long history of that to be able to predict what it's going to be in the future. Now, if you're making 100,
even though in less than 2 years, that might be okay.
Yeah, that's going to be fine. Now you do typically want to see a 2-year work history, but I've even had loans in the past where we used high school jobs, to make that 2-year work history. Even if you work part-time in high school, so generally you like to see a 2-year work history, but when you're coming out of college, if you are working in a field, and this is really kind of loosely sort of policed, monitored, defined, if you're working in a field that relates to that degree that you got, that 4 years of college or however long you spent in college counts toward your work history. And so, in your case, if you got a 4-year degree, or CPAs a lot of times have 5-year degrees, then you really have 6.5 years worth of work history. And you could have qualified for a loan day one out of college because you have a salary position. There's no trouble understanding how much you're going to make. And you can even use future income in that situation, where let's say, you graduate from college in May and your job starts in August, but you found the perfect house in July and you're ready to buy, you can even use that income to qualify. So length of time is fine because it's salary. Now, if you were hourly, wholly different story, and particularly variable. Sometimes hourly can work right out the gate as well with a new job. If you can get very explicit guarantees that there's an explicit guarantee of X number of hours per week. Yeah. Sometimes we can use that because, you can do the math, X hours times the hourly rate. But anytime there's a variable component, then that's when you need to start factoring in some history of work. And that can even be the case where, let's say that you work, let's say you work at let's say you work at Costco and you're an hourly worker, and then you go to work for Lowe's as an hourly worker, doing similar work. You work in the warehouse, you move stuff around. Even that can be problematic. You're going from one variable to another, and let's say you are variable at Costco and you're variable at Lowe's. Even though they're essentially the same type of job, but they're two different companies, and now you still may need some time to establish that. But in your case, very straightforward. Your salary, we can use your salary right out the gate. So I don't see a problem with that whatsoever.
Okay, I want to quickly tell you the one way you can get unique, accurate answers for your specific situation. We know mortgages are confusing. That's why my dad makes these videos, so you can get helpful answers to your questions. So check out our channel to get more answers. We've got tons of videos. But if you want a shortcut to get concrete answers instead of having to do all the research yourself, the best way to do that is to get on the phone with a mortgage advisor. You can meet with my dad, Chris, by scheduling a 10-minute call with him using the link in the description below or going to clevelandstreet.com. You're not obligated to use CSM as a lender just because you call, but he'd be happy to talk and get you started with some answers that you can rely on.